Talk of the tape. How bad might it get for your money at a time when some were planning for a year-end rally? Let's ask Cantor's Johnston, who was not in that camp. He made his case a couple weeks ago. Stocks had some major pain ahead. He's here with me on set at Post 9. It's good to see you again.
Good to see you, Scott.
You nailed it. I don't know what else to say. I mean, 12-2. You said bearish. Let's get bearish. S&P's down near 5% since then. What'd you see?
So I think that the good news in the market, which has been the Fed is done or close to done, inflation's falling, and China reopening, is now in prices, and that's now behind us. And now where we look forward, we have the reality of living with the 5% Fed funds rate, with earnings that are still far too high and need to come down, the economy that's going to continue to slow down even further than where it is now. And we're going to be living with QT, not only here in the U.S., $1 trillion over the course of a year, but also in Europe, as we heard today.
All right, let's go a couple things real quick.
Sure.
So you say the 5% funds rate as if it's in stone.
Okay.
Okay. Powell's trying to chisel it.
Yes.
The market says not so fast, right? 2 years not close to that yet.
Yes.
So there's a disconnect between the two. Why are you so convinced they'll get there?
So I think it'll be 5%, and I'll say plus or minus 25 bips, and I don't really think it's going to matter, because here's the deal, is that the only way they're going to get to 5 or 5.25 is if we're here around 3,900 in equities and things are fine in the economy. The way that they don't get there is if equities are down at 3,700, 3,600, and the economy is starting to roll over, which is why I think it is a lose-lose right now for equities.
A negative no matter what side of the
That's right,
which some make the case.
And part of the issue is that if the market does hold in there and he gets to 5.25%, that's just going to make the fall even greater down the line. So I think it's a lose-lose situation right now at 18 times earnings.
So forget the year-end rally. They all but killed that yesterday? Is that what you think? Despite your overall negative view, that doesn't mean that we couldn't have a tactical move within it, right?
Yes, I think it's very doubtful, and I'll tell you why. Because if you kind of back about a month and a half ago, positioning was very offsides. CTAs were still very short. Hedge fund net long exposure was very low. That has now changed. CTAs bought their $200 billion and are now running net long. Hedge funds have brought up their net long exposure. So that positioning sort of rip due to short covering, I think is probably now off the table. And as we look forward to January and February, there's a couple different issues, which is number one, earnings season. And I do think that estimates are going to come down a fair amount. And then number two is seasonality around January and February. So I'll give you a couple statistics. People think January is typically a good month. In the last 22 years, the market has actually been down in January and February 13 of those times. And during bear markets, it's been down 100% of the time. So if you look at 2000, 2001, 2002, 2003, 2008, 2009, 2020, 2022, January and February, all those bear markets was down each time by a significant amount. So I think we have some headwinds over the course of the next 3 months ahead of us.